broadcast from landlordsjournal.com. The four of us are here together again. Today we're going to be talking about subject to purchases of property. Our company is looking at the new year as a time to buy some more properties, and we might have an opportunity to do some subject twos. We'll just have to see how the year goes, but we want to have that in our toolbox to pull out if it's appropriate. So what are we talking about? What is a subject to?
Subject to is purchasing property subject to existing financing. So if you own a property, I actually acquire the property, purchase it from you, and you subject to the financing that you have. So if you have a mortgage or whatever, I pay the mortgage on your behalf, and you no longer own the property. You either rent it from me, or lease option, or buy it back from me, or whatever. But typically, the people don't stay in the house; they move on, or you rent it out, or whatever. But it's subject to the existing financing.
And subject to, I want to make sure that's clear. It means that the person transfers the ownership, but they keep
exactly
the mortgage or whatever encumbrances are already on the property remain after the transfer of ownership.
Right.
So I'm going to sell you my house. I have a house and it's worth $100,000, and I am in trouble. I still owe $65 on it, and I'm not able to make the payments on that. I've lost my job. I can't make the payments. I'm working now. Commission, and it's just not working out for me. I'm not going to be able to make the payments. So you're saying you'll buy my house, you'll take over the payments, and I can move on, and you'll take over the payments, so I won't have to go into bankruptcy. Is that right? Is that how that works?
And a lot of times, if you're behind, I'll catch up the payments. So if you're 3 months behind, that's when usually they'll start the foreclosure process after the second or third month, and I'll catch your payments up, save your credit, and allow you to stay in the house or not, depending on whether you can even afford it or not. You know, if you can't even afford the $550 or the $1,000, then you'll need to find something cheaper. But you no longer own the house. I do, so you'll have to either rent it from me or do a lease option on an agreed upon price. But usually that doesn't work, because if you couldn't afford it anyway, then you'll have to just rent it. So a lot of times people just need, they get behind, and instead of coming up with, the $1,500, they're just a couple months behind, you can just pay the one payment, so you give them a fresh start. So if say they didn't pay January, February, March, but they have enough money to pay April, but the bank wants all of it. They want January, February, March. You catch that up, and you pay it, and that's it. But a lot of times they'll stay in their house. You guys have any insight?
So this is going to be for a person. You're going to have a seller whose intention is not to go buy another house. I mean,
they're not going to be able to get a loan.
They're not going to.
No.
They don't need any cash out of you.
So what type of person would want to do this? It seems kind of like a extreme.
Special.
It's an extreme situation, but it does happen, as we've seen. Crazy things happen in real estate, as everybody knows. So it seems like the person would, number one, have to be several months behind, and so many months behind because that mortgage keeps adding up, so the problem grows and grows and grows, and they're never going to be able to catch up. And they don't want to destroy their credit score, so they're going to want to leave with their credit intact, but also probably give them peace of mind. I'm sure that it's really stressful to be under that type of situation. It probably stresses relationships.
Yeah.
So you would have to find somebody that meets those criteria.
It's basically to save them from a foreclosure. You don't want a foreclosure on your credit profile. You just that's the ultimate in badness. besides bankruptcy. You don't want that, so it's saving them from that. And that's what you're doing. You're saving them from that, giving them the option to stay in their home if they can afford it.
Mm-hmm.
And sometimes they can't even afford it. If they've lost their job completely, it might take them a long time to get caught up. I don't know, but it's basically saving them from a foreclosure.
Okay.
And a lot of times you'll catch it. And a lot of times people will, which that's not what we were planning on doing, but a lot of times people will sell it again. Like we'll acquire the house. We have a buyer's list. They'll buy the property from us and pay it off and be done with it. So a lot of time you're just like the middleman.
The middleman, you could do a lease option,
Yeah.
perhaps.
So we buy it's $100,000 property. The tenants it's being foreclosed on for $50,000. Happens a lot. You take over the payments. You have a buyer ready to roll. So the buyer will sell it from you for $70,000. You go to closing and you come out with $20,000.
And the benefit to the subject too, as I understand it, is you, as the seller or buyer rather, don't have to put out a lot of cash in the beginning. So
you as a buyer, this is a good opportunity for people that if you want to be in real estate, if you want to be an investor, it's a good way for you to get into the real estate game, kind of the Carlton Sheets way, no credit, no money, all that kind of thing. So you could actually have poor credit, no money, and still make money and doing wraparound. What is that? Wraparound closing. What is it?
It's a wrap.
What's your name? Yeah. You could actually go to
Sandwich
closing.
closing.
A sandwich closing. That's what I was
Sandwich.
looking for. Sandwich closing. So you could actually have bad credit yourself, helping someone that has bad credit, and have no money yourself, and save this person. And then the only hard part is you need to have a seller or a buyer to buy the property from you to make the money at closing. So you could actually have no money, no credit, and come away with X amount of dollars at closing and have a check for you waiting. So your main job would be to find a buyer for the house, and that's why you could do it. Or you could be a buy and hold landlord. You'd be a buy and hold. You could buy it, hold it, keep paying the mortgage until you're ready to pay it off. Go to a bank, say, I bought this house subject to, or I bought this house. Don't say subject to. I bought this house for $30,000. I believe it's worth 70 or 80. I want to pay it off. I want to pay these people off. I want to get a loan for it and pay it off. And a lot of times that they'll do that. They'll say, okay, well, because you own the house. I mean, it's illegal. You own it. You go to the attorney. It's a closing, the whole 9 yards. As long as the seller agrees to it, and then you in turn go to the bank in a certain amount of time. A lot of times people, I've heard like in the forums, people will wait as many as 5 years. Whatever you're comfortable with. I never heard anybody going over 5 years. You don't want to use it as a tool to finance it. You don't want to cap it out. Right. You don't want to hold it until it capitalizes. You don't want to do that. I don't think that's a good policy.
So if you're a buy and hold, though, would you just thought of this? If your strategy is buy and hold, would you yourself have to have maybe better credit in case you have to get a
right?
loan
You
to
would
pay off? And
exactly.
If you're going to turn around and sell the house, which is not our strategy right now for sure,
right?
Then your credit can be a little
right. And even if your credit was subpar, you could still acquire it. And depending on if you had a foreclosure or bankruptcy, you couldn't do it. But if it was just like minor issues, you could wait maybe a year or two and then get cleaned up, and then go to a bank and say, but in 2 years, by the time you're getting your credit cleaned up, you could have acquired God knows how many properties, and then at the end of the 2 years when your credit rating's improved, say, hey, bank, Mr. Banker, I have 15 properties that I've acquired. This is how much equity I believe I have. This is what I've purchased it for. I've been making these payments. They're going to say, oh, that's pretty clever. Oh, that's pretty clever. They're going to 9 times out of 10, if your credit's good and all that kind of stuff by that time, 9 times out of 10 they're going to say, okay, here's the money to pay them off, and then you'll pay the bank directly. And that's your goal. That's what you want to do. This is just a way to acquire a lot of property very quickly, taking advantage of situations, people that are desperate, and people can say you're a vulture or whatever, maybe you are. It's a way to acquire property as a real estate investor very quickly with the least amount of money. So when you go to a bank, and you already have this property, you can get your crap together, and they probably will require you to have I don't know, you can work that around. That's a topic for another show.
I don't think we're vultures.
You don't necessarily have to look at it that way, do you? I was just thinking that myself. You could be helping the seller. It sounds to me like this is a seller that may have. This may be a seller that has waited too long to sell it himself. He doesn't have that
Right.
window. He has.
You're their
He
angel,
has been
actually.
in somewhat, maybe some. He's been in some cash flow denial for a while, thinking
Mhm.
he could,
Mhm.
thinking he could get a better job, somehow get his income back and make things work. And instead of he could have got it on the market himself and maybe not had to do it. But now he doesn't have the time, and you're coming to him and saying, you know, this is somebody who's going to be foreclosed on maybe in the next 2 weeks or
Mhm.
something, and you're gonna say he's circling the drain. You're gonna save him,
Right. Right.
and
Yeah.
so at that point, it's unrealistic that he's going to be able to sell the place, and all that he's got now that he can salvage is his credit, and this is the way you're going to salvage
happy
his
to do it
credit
at that
for him,
point.
and he's going to be
Mhm.
able to get a new start.
Right.
And I
he's
think
gonna
that's
be able
when-
to get him an apartment and move on.
Starting over win-win, because we are not slumlords. We are not going to take advantage of people. We never said that from the beginning with this company. That's something I'm totally against. You know, when we do these things, it is actually meant to help us, but it helps those people too. And we have done that in the past. We have helped people out of bad situations. Yes, you know, with
Mhm.
some of our other properties. I mean,
Mhm.
obviously,
Mhm.
we came out ahead on the deal, which is good. But they came out ahead because they were out from under this rock, hanging by a thread over their head. You know, so that's
we've done that.
not a bad thing. That's actually a good for both parties sort of thing.
Right.
And
And
that's
that's what we
important.
want.
That's good
what
for
we want.
business ethics.
We want a win-win situation.
It's good for
on
business
everything.
ethics, and I think we need to always say that.
And
We're not shysters here.
The problem that you hear a lot of these, like on Dateline, on different shows, a lot of these problems gone. A lot of these things, people are. What am I looking for, Bob? What am I trying to say?
Predators?
Predatory people that go in and say, okay, we're going to buy your house, we're going to catch up on your payments, blah 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 blah. The people don't realize that they're actually selling their house to the person. You know, like I'd go in and tell you, John, that I'm going to catch your payments up, I'm going to let you stay in your house, blah, you know, all that kind of thing. I don't tell you that you're actually signing your house over to me and actually own it. You no longer own the house. When you do a
Right.
subject to, you no longer own it.
You don't have control over the property.
You don't have control over the property. I can say, bye-bye, you know, you're out of here. You're still paying, you're still responsible for the mortgage. You're still responsible for the payments. So what happens is, I don't do what I said I was going to do. I don't pay the mortgage. I wait till they actually foreclose on you. You lose the house anyway. I own the house now. Then I go to the bank and say, oh, okay, I'll pay this off, and you know, kind of like that whole short sale thing, the whole thing with Dwan. You know, I'll go ahead and pay it. You know, those people are out of the picture. They're gone. Their credit's ruined anyway. So you basically lie to them. That's what the stuff you see on Dateline
Right.
and the predators that do that. I'm not.
They don't
I-
make a payment. That's
they
what it
don't-
boils-
they take over
don't
the
make a
house.
mortgage, yeah.
They take over the house. That's shady. We don't do that kind of thing.
So they change title, but they don't make a payment.
They don't
That
make a
is-
payment.
that's
So the
awful.
people were in the same boat that they were anyway, except the only difference is now you own the house. They no longer own it. Their credit's ruined. So instead of doing the right thing, you know, telling them, doing what you told them to do, told them that you were going to do, you know, catching up on the payments, saving the credit from a foreclosure, all that kind of stuff, you don't. And there has to be some kind of level of trust there. And that's why I was saying you maybe get an attorney
I was
involved.
going to say that's a good segue. What can we do legally to put the person's mind at ease and get them to understand? I mean, what as having business ethics and being an ethical business, what can we do to ensure that it's a positive transaction?
Getting an attorney involved, and then make the payment to the attorney, and the attorney makes the payment to the bank,
Like an
and
escrow
then
account.
like an escrow account, exactly, an escrow account, and then the homeowner can, or it's actually not the homeowner anymore, the mortgage, the
Title holder.
title, or the
Not title, but the
Mortgagee.
lien holder.
lien, yeah,
Mortgagee.
the mortgagee,
Is that
the
a better term?
mortgagee.
Mortgagee.
Oh yeah,
Well,
we'll
the lien
have
holder is the bank.
the bank,
Yeah,
the
that's-
mortgagee, the person who's making the payment.
Yeah.
On you, the person that's responsible, the responsible
Responsible, not
party
making
for the
payments, but
payer, yeah,
responsible.
the responsible party for the actual mortgage can call the attorney and say, has that been paid? Or maybe the attorney can give, you know, a
Monthly statement.
monthly
or something,
statement or
whatever
whatever.
it's paid.
So I think that in that kind of situation, and I don't know how much that would cost, but I think in that kind of situation it'd be good for I think that'd be a good
of
policy.
mind sort of
Peace
thing.
of mind, so they know that it's all legit, and you're not trying to be shady, and that kind of thing. Because that does happen. People will do that. They'll promise you the world. They won't make a payment one, and then they own your house, and you're responsible for the payment, and you were foreclosed on anyway. You lost your house anyway.
Now
Like
you
I
lost your
said, the only difference now you don't have credit. The only difference is someone else owns your house. You don't even own it anymore.
Right.
But you might not have owned it to begin with. But dude, you want some, what's the word I'm looking for?
Predator.
Predator, skankster, whatever, some scammer coming in taking your. I mean,
Shyster.
shyster. That's what
Shyster.
I'm looking for. I can't talk today. Some shyster coming in and taking your home. You'd probably rather give it to the bank. I don't know.
Yeah. That's true.
But there's an important risk you have to prepare for as the buyer, and that is that the mortgagor, the bank could ask
Due on
for
sale.
a
They
due
call
on
it
sale,
Call the loan due.
call the loan due,
Exactly.
and then
Explain that, because if somebody's watching this, they're not going to understand.
Usually in mortgages nowadays, or it has for the past couple of decades actually, there's a due on sale clause, and that was to prevent there used to be a lot of fluctuations in interest rates. So the due on sale clause helped the save the bank from people manipulating the system. So if you sold it to somebody, the mortgage would come immediately due.
In full.
The full
In
balance.
The full balance. So, say that you had to basically, if it was sold, I would have the option to refinance, but it'd be refinanced at a higher rate. If it was 10, 13% or whatever, you could do that, and I would have to I'd have to buy it from you, but at a much higher rate. Typically, the banks don't do that unless there's a big fluctuation in interest rate, and they have to find out about it for one. But usually they'll do that when.
And then when you say they have to find out about it, make sure they only if they find out about it is it an issue. And there's, at least where we are, there's not any kind of automatic notification to the lien holder upon the transfer.
Yeah, our
of ownership.
state doesn't, to my knowledge, as of this recording, doesn't notify the lien holders that there's been a change in title. Like insurance companies will typically, if there's a lapse, if there's a non-payment insurance, they'll notify the lien holders that the insurance hasn't been paid, or if the taxes. Now our county does notify the lien holders if the taxes haven't been paid. If they're going to start on the courthouse steps, they will notify them about that. But as far as we know, there's no notification that there's an actual change in title. And even if there was, the bank has the option to. They don't have to. They don't always do it. And a lot of times, as long as they're getting their money, unless there's a big difference in interest rate, like if this person's interest rate was 7% and their new one's 13, of course they're probably going to activate that due and sell clause. They're going to initiate that. But it basically depends on the interest rate.
Yeah.
And that's why they do it, is because of the fluctuations in interest rates, and a lot of times they vary greatly. Right now they're not, and right now I don't believe that they're doing that as much. I mean, I'm sure it happens, but probably not as much. But you have to be prepared to pay it off. Worst case scenario, you want to be able to maybe go ahead and get the ball rolling. Maybe that's why you want to wait a couple years. You don't want to do it as a financing op. You don't want to do it as your main mechanism to finance houses, and finance it for keeping it that way. I don't think that's not good policy. Like I say, we can go into that later, but you want to do it. It's a short term thing. It's a way to acquire a lot of money, a lot of property very quickly with very little money. And you can buy and hold it. You can sell it. You can lease option it. There's a lot of things you can do it because you actually hold title. I mean, you hold title, so you actually go through all the processes that you go through when you purchase a home. You go to an attorney and buy it, because attorney has to.
In essence, it is just a different mechanism for financing a home. All the other rules that you would go forward with in a purchase of a home, you would still do all your due diligence the same exact way. The only difference is this is an alternative financing
And
mechanism.
people, I can see that we're already going to get comments based on, so we always have said we don't want to purchase a property that when there's a lien on it.
Right.
We don't want to do that. And I could see someone saying, why is that policy different than this? And does someone want to explain that?
Well, one big difference is it's not really any difference than if we went to a bank and financed it ourselves. There would have to be a lien on it to get a mortgage anyway. So this is just that the lien happens to be in someone else's name. It's not really any different than a regular mortgage that would be in our name. It's just that they're holding it instead of us, with that little caveat that the bank does have the capability of requesting full payment in full. And so that's something you need to be prepared to address. It should that happen, and we don't have enough experience with that happening to give you any kind of likelihood.
So in essence, could we say we did purchase, we were interested in this house, but there was a lien on it. They weren't in distress. There wasn't anything like that going on, but there was a lien on it.
You say lien, you mean primary mortgage?
Primary mortgage,
You're not talking
right?
about a secondary.
No, I'm talking about primary
I just wanted to
mortgage,
make
and there
that
could be
clear.
a secondary.
There could be.
That even makes it more complicated. I don't know, yeah, but say there's only one.
Okay.
There's only one primary. There's a primary mortgage on it. In the past, we had discounted that and kind of moved away from that.
Yeah, we do.
Could we revisit that and say, well, as long as we have the money in the future, if they had happened not to pay it, would that actually put us in a good position? Maybe we do a short sale with them. Even I don't know how that would work because we'd actually be a lien holder too. Well, actually, we wouldn't be a lien holder. We'd actually own the property. So I mean, how would that?
How would what?
Okay, I'm confused. Because you're
Restate the question.
mixing short sale and.
We always
subject to.
discounted the fact that the lease up when we purchase a property, it needs to be clear of any liens.
Right. Yes.
Well,
Clear.
we were. That's when we were looking for owner financing.
Right.
I think if you want owner
Which is another
financing,
tool.
you got to have the owner has to have some equity enough to finance it, right?
Mm-hmm.
But this is no different
But
than a
this
bank
is a-
giving us a loan. It's really not. It's no different. So I mean, it's just that
The one
this
advantage is we don't
loan already
qualify
came
it.
pre-built.
Yeah.
Somebody else has already done the legwork on the loan, and they've gotten their own name. It's not really any different than if we went to a bank and said we want to purchase this property for the agreed upon price, and we want you to give us a mortgage. It's exactly the same as that, except it's already done and it's not in our name.
But we have to approve their loan. I mean, we would have to look at the papers. I wouldn't want to just
I
accept
guess
every.
You would never
It
do.
would
Yeah,
have
I know,
to
but
be
I'm
a
saying
good- it would have to be a
those terms have to be
appropriate
favorable
mortgage.
for us.
Yeah.
We need to look at how much is owed, what's the interest rate, what are the terms. I
Well,
mean,
of course,
I
you have
know
to know
with
you have to know what the
anything.
payment is.
I know,
Yeah.
but there would be some that if we talk to people like, I'm sorry, that's not going to work for us. Oh yes,
they-
we can work with you on this.
You
so
wouldn't
there
want
are
to
some
buy one
differences.
for example, one that you owe more, where the mortgage is for more than the value. If they're underwater,
all the
something like
same
that,
all the same
No.
rules apply
it
on
doesn't work
as a
for that
conventional.
kind of thing.
All the same rules about whether to purchase something apply the same with this as it would if you had a bucket full of money and you were going to pay it out of a bucket full of money.
But that you might do that if you were betting on the prices going back up,
Back
like in
up.
Miami.
That's not our MO.
No, but I'm just saying there's
It's-
people
there's
there's people all
that
over the country, and like
You were in
in
Florida,
if you're in Florida,
probably.
you might
That
do
strategy
that
would
because
probably
you were
work well.
thinking, there might because prices
If you were a
probably
speculator, you could
prices
do that.
are, and people are doing that. I mean, it's more than what we would want to handle, but they're speculating that the prices are going to go way back up. Maybe not as high as they were, but they're going to go back up.
Gonna
Around
bounce
here,
and
we don't have
bounce
that problem.
fast.
Yeah, exactly. So you can acquire all this property, maybe have a small negative cash flow. I'm not saying you get in the habit of doing that, but down there, you might have a small negative cash flow, but the rewards can be tremendous down there. And there are people doing that. But that's a situation where you would do that. Now, around here, no, but somewhere like that where it could rebound very quickly, it falls very quickly, can go up very quickly.
So it sounds like
As long as you're in the right place at the right time.
It sounds like to me the main problem then would be getting the concept across to somebody, because I'm just now kind of catching on myself, and I've been at this a few years and I haven't really thought about this tool. Getting the person to understand what's happening. So
Absolutely.
So John, just for our viewers, if I'm a distressed homeowner and you called me or sent me a letter or something and I'm interested, you've hooked me and I want some more information. If I was Mr. Smith and I'm in trouble, What
Right.
would you say to me as a homeowner and not a real estate person? How,
I
how
would-
would you make me?
I would tell
understand?
you. I would tell you basically what we talked about, and I would get an attorney involved. I would say, let's get our attorney on the phone. We make payments to her. This is all legit. We make payments to them, and they pay the mortgage. That way, there's nothing. We're not trying to do anything shady. We're not trying to, do a dateline on you. We're not trying to take your house and not pay your mortgage and you're bankrupt, and all that kind of thing. We're actually helping you to help us.
But do I get to stay in my house?
Only if you can afford it. You'd have to almost qualify to stay there as the same as you would. Anyway, I mean, like say you're 3 months behind. A lot of people get 3 months behind. They just can't catch up, but they can pay the 1 month. If you're $1,500
Right.
behind, the bank wants all of it. But you might be able to afford the $500 a month. You might actually be able to afford it. You might actually not be able to afford it. So you would base the situation on that. So we'd have to do a list of, can you afford to stay in this house? Is it important for you to stay in this house, or is it important for you to save your credit? So you can buy another house on down the road. Because if you have a foreclosure on your record, your credit's ruined for 10 years. Period. You won't be able to buy not anything. But if you go ahead and salvage the situation now and maybe rent something that you can afford, we have some nice rentals. I mean, we do.
Come look at our
We have some nice
portfolios and
rentals. You go to myhuntingtonhome.com and look at our rentals. You
I
can
would
stay
encourage
in what-
everybody to do that.
Yeah. You can do that. I mean, maybe you can't afford to stay in this house. That's what I would say. I'd make them feel comfortable. I'd get an attorney on the line. Have a good. It's a legal closing. It's all legit. You go to the office, you close on it. Maybe use them as an escrow and make them feel very comfortable. It's not okay. You sign your name with a piece of paper in this back room, and in the dark, and that's it. And that's what happened. That's what.
Maybe you could work out something like maybe I'd ask you, how much time do you need to stay in this house? How much time do you need to find you somewhere else to live?
Right.
Could we work out? Could we work out a 6-month mortgage on you with you for a certain amount of money,
X
and then you're going
$100
to
a month.
leave? I mean, maybe there's something creative you could do there that's going to help you move ahead. I don't know.
So even though their name is on the lease, you could still foreclose and evict them.
You won't be foreclosing because they don't own it anymore, but you can evict them
Evict,
because
rather,
they'll
excuse me.
be renting
They'll be
them.
renters.
Right, they'll be
Their
renters
name,
at
even
that
though
point.
that doesn't make any difference that their name is on the note. You
Right,
can still
exactly. You
Evict
can still evict them because they'd be renting. You sign an agreement because they actually sold. This would be the same as if you went to a bank, like say I bought this house. It'd be how much time do we have?
them. 5 minutes. We need to
5
wrap it
minutes.
up.
We need to wrap it up, so I'll say this real fast. It'd be the same as me buying this house, through the traditional means. Went to a bank, borrowed the money, paid for it. The title would change hands to me from you. You'd be a renter at that point because you would no longer own the house, or you'd be a renter or a squatter, one, if you didn't pay or whatever. But it's the same thing. So I'm going to do closing thoughts.
Okay, so my what I get from this is that a subject to deal is one where essentially, as the buyer, you're taking over the payments for a person for their mortgage. You're just going to take over their payments for them, and you're going to take title of the house. You're going to make their payments. What they get out of it is they salvage their credit. They're not going to have a foreclosure on their credit. They're going to get a fresh start, and what you're going to get is you're going to be able to get this property without qualifying yourself for a loan. The caveat is you need to be prepared to address a possible due on sale due on sale movement from their bank. And it would.
It's also about educating. It's I think the number one hurdle to due on sale is educating the seller to make them comfortable with such a non-conventional transfer of ownership. I think that's the number one hurdle.
And a lot of times these people are in distress. So as long as they don't feel like if they're getting something in return, what they're getting in return is not a bad mark on their credit profile, or they're able to stay in their house.
And what you could do, even like you were talking about different tools for the job, and we kind of had one house come up where we were talking to somebody, but I don't think the guy he didn't really understand what was going on. He was past that point, and he probably let his house go into foreclosure when we offered to step in to try and do something before
Right.
then. So you could even follow those properties. Maybe
Yeah.
they do get foreclosed on.
That's true.
Okay, that's fine.
Go to the bank.
Go to the bank
Go to the
then
bank.
and deal with the
Right.
property.
Because we
with
actually
somebody
do.
else.
We've gotten a few leads about what's
Mhm.
about that situation,
Yeah.
so we can even follow those up.
That might be worth
We
your
haven't
effort,
used all of our
time.
tools, and it's about understanding the tools at your disposal. And this is
Yeah.
this is just one of them, but it's the tool for the overall purpose of acquiring, like I've said, acquiring as much property as you possibly can with the least amount of money. Because it's that whole cash on cash return. If you're spending $50,000 to make $20,000, if you're spending $50,000 to make $5, I mean that's a lot. If you're spending $300,000 to have $100,000 equity position in 5 or 6 properties, you're much better off than spending $50,000 to have a $300,000 or $100,000
One house.
equity position. So it's about using your limited resources to acquire as many assets as you possibly can, and use that money for to fix it up, to do whatever. And this is a tool, one of the tools to do that. A subject to is one of the tools to do that, of the overall goal to acquire as many assets as you possibly can with the least amount of money. And that's the whole goal.
Well, thanks for tuning in and listening to us talk about the subject to technique for buying properties. We're hoping to find in our future some opportunity to use this, and we're looking forward to a good 2011 here. And thanks for tuning in to landlordsjournal.com.